everybody, this is Kristi Isais, the new construction realtor in the Phoenix metro area. Wanted to do a very quick little video today about the pros and cons versus utilizing a down payment assistance program or coming in with your own down payment and doing an FHA or conventional style loan. So let's just jump right into it. Coming in with $0 down payment, qualifying for a down payment assistance program has its pros and cons. Obviously, biggest pro, $0 down payment, right? That's one of the biggest perks, and especially with my situation, I'm able to at times get people into a brand new construction home for just $500 out of pocket. Also $0 closing costs utilizing my preferred lender that I absolutely adore. I'm sure you guys already know who she is. So that's the perk of down payment assistance program, $0 down payment. Let's look at some of the backside of that. It locks your rate in for 3 years. So you're not able to refinance, you're not able to do anything of that nature within that first 3-year mark. So if rates drop 2%, you're stuck. You can't really refinance that loan. That's kind of a downside. You don't have that freedom and flexibility. 2, if you choose to sell the home in 2 years, you will be required to pay back a portion of that down payment that was gifted to you. So it won't obviously be that full amount, the 3% or possibly a 4%. It will be a proration of that percentage. So that's kind of a downside. 3, you will need a 640 or higher credit score in order to qualify for that program, which isn't the worst thing in the world. And then lastly, you will be required to take a 4-hour home buyer course online that costs approximately $75 in order to qualify for the loan as well. So those are all of kind of the ins and outs of the down payment assistance program, pros, cons. Now let's look at the latter, right? Let's look at the other side of it. If you come in with your own down payment, even as little as 3%, you're going to drastically lower your interest rate, which will drastically lower your monthly payment. Now I shouldn't say drastically because rates go all over all the time, but you get my drift. Your payment will be lower if you bring in your own down payment. 2, if you sell the home in 2 years, it's up to you. It doesn't matter. You're not going to be penalized. 3, you buy your house and in 2-3 months rates drop 2%, you can refinance the loan. You have more freedom and more flexibility to doing, doing anything when you bring in your own down payment. That's basically it in a nutshell. You have more freedom and flexibility with your own. You're going to have a lower down payment. Now, I will say, when you bring in a 20% down, that's going to be your best case scenario, right? Because you're going to not have any private mortgage insurance. Anything under a 20% down, you will be required to pay they call it private mortgage insurance. And that is the lender's insurance policy that protects them if you ever default on your loan. So that monthly payment varies depending upon how much your loan is, and how much money you've put down, your debt to income ratio, etc. Now my lender can probably do a video on that and explain that in greater detail. That's her lane, I'm going to stay in my lane. So yeah, 20% or higher, better interest rate, no private mortgage insurance, lower monthly payment. So there are pros and cons to everything, but I would urge you guys, if you're kind of wondering which route to take, get in touch with me. I will connect you with my lender partner. She can dial this in 150% for you and really give you multitudes of education on it so you really feel empowered to making the best decision. So everybody have a great day. You need me, you know where to find me.